There's a date hiding in your retirement that most people don't see until it's too late. That date is 73. Once you hit it, the government changes the rules on money that's already yours, not in a sudden way, but in a quiet way that catches people off guard every single year. The money sits in your traditional IRA or 401k, gathering dust, and you think you're safe because you earned it and saved it. Then the IRS sends a message that feels almost absurd: withdraw this amount or face a penalty. If you get it wrong, the consequences compound in a way that most retirees never see coming. But here's what most people don't realize. The rule isn't random, and it's not designed to trap you. It's actually designed around how long the government thinks you'll live. In a minute, I'll show you exactly how this math works, why it changes in 2026, and the 5 specific moves that trigger audits. But the last part changes everything about how you think about this whole system. If you're anywhere near 70, or if you're managing money for someone who is, this is the conversation that saves you thousands. The mechanics are simpler than the fear around them suggest. Let me start with what actually happens. Once you reach what the IRS calls your required minimum distribution age, you cannot keep all your money in a traditional retirement account forever. The government forces you to withdraw a minimum amount every single year. This withdrawal is calculated by a specific formula: the balance of your account as of December 31st of the previous year, divided by a life expectancy factor. That number you get is the absolute minimum you must take out. Take less, and you pay a penalty on the shortfall. Most people think this is unfair because the money is theirs. But the reason exists: the government wants to tax the money while people are still alive to pay it. These accounts were designed with tax deferral in mind, not tax avoidance forever. The tension people feel is real, though you finally have money saved up, and suddenly you're forced to withdraw it, whether you need it or not. That's the human problem at the center of this rule. Now here's where it gets specific about your situation. The age at which this kicks in depends on when you were born, and it changed under recent legislation. If you were born before July 1st, 1949, your required minimum distribution age is 70 and a half. If you were born between July 1st, 1949 and December 31st, 1950, it's 72. If you were born between January 1st, 1951 and December 31st, 1959, it's 73 first. If you were born January 1st, 1960 or later, the age becomes 75, effective in 2033. This is not a guess or a recommendation. It's the current law. Most people approaching 73 don't know this has changed since they were younger. Here's where most people start feeling confused. There's not one calculation method. The IRS has 3 different life expectancy tables. Table I is for beneficiaries, and it's rarely the right one for you as the account owner. Table 2 is for people whose spouse is more than 10 years younger, and it extends the payout period significantly. Table 3 is called the Uniform Lifetime Table, and about 95% of retirees use this one. The mistake happens when someone uses the wrong table. This feels small until you do the math. Let's say you have $400,000 in your traditional IRA, and you're 73 years old with your spouse who is 60. If you use Table 2, your life expectancy factor at age 73 with a spouse that age is approximately 297. $400,000 divided by 297 equals $13,468, which is your required minimum distribution. But if you accidentally use Table 3 instead, your life expectancy factor is 265. $400,000 divided by 265 equals $15,094. You just overpaid by $1,626 in a year. You didn't need to. Over 5 years, that's over $8,000 you withdrew unnecessarily. Most people miss this detail because nobody explains which table applies when. This is where it gets real. Now the stakes change in a second way that almost nobody anticipates. If you have multiple traditional IRAs, you must calculate the required minimum distribution for each one separately. But here's the relief: you can withdraw that total combined amount from any of those accounts in any combination you want. You don't have to take it from each individual IRA. However, if you have 401ks, the rule is different and stricter. 401k RMDs must be taken from each 401k separately. You cannot aggregate them, and you cannot substitute an IRA withdrawal to cover a 401k shortfall. This is the part where people get audited. They take their entire RMD from one IRA and assume they're covered, forgetting about the 401k their former employer is still holding. Pay attention to this part. There's a timing trap that catches retirees almost every year. Your first required minimum distribution can be delayed until April 1st of the year after you turn 73. But many financial professionals recommend taking that first distribution in the year you turn 73 instead. The reason is tax timing. If you wait until April 1st of the following year, you now have 2 required minimum distributions due in a single calendar year, one from the current year, one from the previous year. That double distribution can push you into a higher tax bracket, and it can affect other tax-sensitive items like Social Security taxation or Medicare premiums. So the strategy most qualified professionals recommend is to take your first RMD in the year you turn 73, then take subsequent ones by December 31st each year. This spreads the tax impact across 2 tax years instead of bunching it into one. Now here's what the penalty structure looks like. And this is where the system changed. Before 2023, if you missed your required minimum distribution or took too little, the IRS imposed a 50% excise tax on the amount you failed to withdraw. This was brutal. If you were supposed to take $20,000 and only took $10,000, you owed a $5,000 penalty on top of income tax. Starting in 2023, the IRS reduced this penalty to 25%. So in that same scenario, $10,000 times 25% equals $2,500. That's half the hit, which is significant, but there's a relief measure if you correct the shortfall within approximately 2 years. The penalty can drop to just 10%. Most people never hear about this provision. They panic when they realize they made a mistake, assume the worst, and never ask about correction. If you contact the IRS and file an amended return showing you've corrected the distribution, many situations qualify for the lower penalty or even full waiver if it was a good faith error. Now let's talk about the 5 specific mistakes that trigger this whole sequence. The first mistake is using the wrong life expectancy table, which we covered. The second mistake is calculating your required minimum distribution based on the current year's December 31st balance instead of the prior year's balance. This is the rule: you use the account balance as of December 31st of the year, before the distribution is due. So if you're taking your RMD in 2025, you use the December 31st, 2024 balance, not December 31st, 2025. This matters because market fluctuations can swing the balance significantly. If the market was strong in late 2024, your balance is higher, so your RMD is higher. If you used your 2025 balance, you might take too much or too little. The third mistake is forgetting to include inherited IRAs in the calculation. If you inherited an IRA from someone other than your spouse, the rules become more complex. Under the Secure Act, non-spouse beneficiaries have a 10-year window to empty the inherited account. This creates required minimum distribution calculations of its own. Many people inherit an account, file it away, and forget it exists. Then 10 years later, they realize they need to drain it by a certain date or face penalty. The fourth mistake is not understanding that Roth IRAs have completely different rules during the owner's lifetime. You never have to take a required minimum distribution from a Roth IRA while you own it. This is the strategic advantage of Roths. You can let them grow forever without forced withdrawals. Your beneficiaries will have different rules, but you as the owner have freedom. Many people assume all IRAs follow the same distribution rules and end up taking withdrawals from Roths unnecessarily, when they could have taken them from traditional accounts instead. The fifth mistake is not knowing that qualified charitable distributions can count toward your required minimum distributions. If you're charitably inclined and over 70 and a half, you can direct up to $105,000 per year from your IRA directly to a charity. This amount counts toward your required minimum distribution requirement, but it's not included in your taxable income. Most people miss this because their tax advisor never explains the rule, or they don't know the rule exists. A qualified charitable distribution is one of the cleanest tax moves available to retirees, and it remains underused. Here's where it gets strategic. There are situations where you can delay taking required minimum distributions from your 401k even after you've reached the distribution age. This is called the still working exception, and it applies if you're still employed at the company sponsoring the 401k, and you don't own 5% or more of the company. In this case, you can delay 401k RMDs until you actually retire. This doesn't apply to IRAs, only to 401ks from your current employer. Many people leave a 401k with a former employer and assume they can delay it because they're still working. That's wrong. The still working exception only applies to your current employer's plan. Your old employer 401k still require distribution. Now let me show you what happens when you understand the table system. Most people spend years earning money, and when they finally stop working, they think the complexity ends. It doesn't. The complexity shifts into managing distributions and minimizing taxes. The table system exists because the IRS is calculating your expected remaining lifespan. and spreading your account balance across that lifespan. Table 3. The uniform lifetime table that most people use assigns a life expectancy factor based on your current age. At age 73, the factor is 265. At age 80, the factor is 187. At age 90, the factor is 114. At age 100, the factor is 71. This means as you age, the factors get smaller, and your required minimum distribution actually increases as a percentage of your remaining balance. This is deliberate. The government wants larger withdrawals as you age, because your life expectancy is shorter. For someone in their early 70s who has a large balance, the initial distributions can feel manageable, but by age 85 or 90, those same large balances are generating larger and larger required minimum distribution. Most people don't anticipate this compounding effect because they're focused on the initial calculation. Now here's the twist that changes how you think about this entire system. The rule isn't really about the IRS forcing you to spend your money. The rule is about consistent taxation, documentation, and forcing realization of gains during your lifetime, rather than leaving everything to heirs. If you understand this as a taxation and estate planning issue rather than a punishment, the whole dynamic shift. You're not being trapped. You're being asked to plan around a known schedule. This is where it gets strategic and where documentation matters more than most people realize. Keep records of all your required minimum distribution calculations and distribution. Keep your year-end account statements from December 31st. Keep documentation of the life expectancy factor you used and which table applied. Keep proof of all withdrawals, whether they came from traditional IRAs, 401ks, or other qualified accounts. If you ever get an IRS notice, these documents are your defense. Most people lose these documents, and when they get a notice, they're scrambling to reconstruct years of history. A simple spreadsheet or folder that tracks this information every December saves you enormous stress. This is where preparation beats panic every single time. Most people who face RMD audits weren't trying to cheat the system. They were just confused about which rule applied to their specific situation. The IRS knows this, which is why correction provisions exist. But you have to know the correction provisions exist to use them. And you have to be proactive rather than reactive. The clean way to think about this is 4 steps. First, determine your actual required minimum distribution age based on your birth date. Second, identify your account type and gather your December 31st balances from the year before your distribution is due. Third, identify which life expectancy table applies to your situation, almost certainly Table 3, unless you have a significantly younger spouse, in which case it might be Table 2. Fourth, calculate your required minimum distribution using the formula prior year balance divided by your life expectancy factor. Fifth, set up an automatic monthly or quarterly distribution so you don't miss a deadline. Sixth, consider whether a qualified charitable distribution makes sense for your situation if you're charitably inclined. This 6-step sequence removes the panic and replaces it with process. Most people feel anxious about this rule because they don't have a process. Once you have a process, the anxiety evaporates. Now here's the part where most people don't go deep enough. There's an interaction between required minimum distributions and your Social Security taxation that almost nobody anticipates. Depending on your modified adjusted gross income, part of your Social Security benefits might be subject to tax. A large required minimum distribution can push income into ranges where more of your Social Security becomes taxable. This creates a secondary tax effect that compounds the direct effect of the distribution itself. Someone might be surprised to learn that a $30,000 required minimum distribution actually cost them $35,000 or $40,000 in total taxes when you factor in Social Security taxation and potential Medicare premium adjustments. Medicare premiums are also income-based, so higher required minimum distributions can trigger higher premiums several years later due to lag in income calculation. This is why the timing of your first RMD actually matters. Bunching 2 years of distributions into 1 year can trigger premium increases that last year's. This compounding effect is invisible until someone goes through it once. Then they understand why financial professionals recommend spreading distributions across tax years when possible. Here's another angle most people miss. If you have children who might inherit your retirement accounts, the rules have changed significantly for them too. Under the Secure Act, if they inherit a traditional IRA, they have a 10-year window to drain it completely. They cannot stretch it over their lifetime as was possible before 2019. This means that required minimum distributions hit them in a compressed time frame, potentially pushing large income into single years. If you're aware of this as the account owner, You might make different choices about what to distribute during your lifetime and what to leave. Some people might decide to take larger distributions themselves and pay the taxes at their rate, rather than leave larger balances that force compressed distributions into their heirs' years. This is an estate planning consideration that sits at the intersection of required minimum distributions and beneficiary planning. Most people never connect these two conversations. They think about RMDs separately from estate planning, when they're actually deeply intertwined. Now let me walk through 3 real scenarios where the numbers get specific. Scenario 1. You're a business owner, age 73, with $600,000 in a traditional IRA and no spouse. You use Table 3, and your life expectancy factor is 265. $600,000 divided by 265 equals $22,641. That's your required minimum distribution. You can take it in one withdrawal, or you can take it in monthly installments throughout the year. Many people take it monthly, around $1,887 per month, because this approach reduces the behavioral urge to spend it all at once. Results vary based on individual financial discipline and needs. Scenario 2. You're married, age 73. Your spouse is 62. You have $800,000 in a traditional IRA. Because your spouse is more than 10 years younger, you qualify for Table 2. Looking up age 73 with a spouse age 62 on Table 2, your life expectancy factor is approximately 340. $800,000 divided by 340 equals $23,529. This is lower than the first scenario, even though the balance is higher. The younger spouse extends the payout period, which reduces the annual withdrawal requirement. This is the benefit of having a younger spouse when it comes to required minimum distribution. Results vary depending on exact ages and balances. Scenario 3. You have 3 traditional IRAs. IRA 1 has $150,000. IRA 2 has $200,000. IRA 3 has $175,000. You must calculate your required minimum distribution for each one separately using Table 3 at age 73. Your life expectancy factor is 265. IRA 1, $150,000 divided by 265 equals $5,660. IRA 2, $200,000 divided by 265 equals $7,547. IRA 3, $175,000 divided by 265 equals $6,604. Total required distribution, $19,811. Now, you can take this $19,811 from any combination of these accounts. You could withdraw the entire amount from IRA 2. You could withdraw from all 3 proportionally. Proportionally, you could withdraw from one account one year and another account the next year. As long as the total amount is met, the flexibility here is often a relief for people who thought they had to take proportional amounts from each account. Results vary based on your preference for consolidating accounts or maintaining separate investment. Now here's what's often overlooked, the administrative piece. Most custodians like Fidelity, Schwab, or Vanguard will calculate your required minimum distribution for you if you ask. You don't have to do this math yourself. You can call them, provide your information, and they'll tell you the exact amount you need to distribute. But they'll only calculate it if you ask, and they'll calculate it based on the tables and rules that apply. If you don't specify that you have a younger spouse, they'll default to Table 3. If you don't tell them you have other IRAs, they'll only calculate for the one account. You have to be the person who knows the full picture and provides that information to them. Most people don't realize this is part of their job. They think the custodian will automatically handle it. The custodian handles compliance once you've given them the correct information. But you have to know what information to give them. This is where documentation and personal responsibility matter. Now here's where it gets simpler than it feels. If you automate your required minimum distributions, you can almost forget about them. Many custodians allow you to set up automatic distributions that occur monthly or quarterly. Once set up, the money flows out consistently, and you remove the December 31st deadline panic. You also remove the temptation to get just one more quarter of returns before distributing, which often leads to missed deadline. Automation is not flashy, but it's one of the highest leverage moves in retirement planning. Most people who have automated their required minimum distributions report significantly lower anxiety about the requirement. The rule hasn't changed, but their experience of the rule has changed. Here's a micro checkpoint. If you're under 73 and you haven't thought about this yet, the best time to start thinking about it is now. If you're already 73 or older and you haven't started your required minimum distributions, The next best time is today. Delaying this conversation doesn't make the rule go away. It just creates a larger compliance and catch-up problem later. A qualified tax professional or financial advisor can confirm the specific rules applying to your accounts and your situation. Different states have different considerations, and some employers have unusual retirement plans with different rules. You need someone who knows your full situation to advise you properly. Now here's the final piece that changes everything. Once you understand how required minimum distributions work, you can actually use them strategically. If you have taxable brokerage accounts outside retirement accounts, you can coordinate which account you withdraw from in high-income years versus low-income years. If you have traditional IRAs and Roth IRAs, you can sequence your distributions to minimize the tax on required minimum distributions, while still converting some traditional IRA money to Roth in lower-income years. If you have a qualified charitable distribution opportunity, you can shelter your required minimum distribution from income tax entirely, if that fits your values. None of these strategies are available if you don't understand the basic rule and the exceptions. But once you understand them, your options expand significantly. This is the strategic layer that separates people who feel trapped by required minimum distributions from people who feel in control of them. The rule itself doesn't change. Your perspective and planning do. 3 things to remember: the age you begin taking distributions depends on your birth year and ranges from 70.5 to 75 going forward. The calculation depends on your prior year balance and the correct life expectancy table for your situation. And mistakes here can force unnecessary withdrawals. The penalty for missing distributions dropped to 25% from 50%. But correction provisions exist if you made an honest error. If you want a simple calculator to see how your specific situation would work, there are resources available, and you can find them in the community or by asking a qualified professional. If this helped you understand how the rule actually works rather than just fear it, share this with someone who's approaching 73.